Today, we're diving into a fascinating topic in the world of investing. We'll be exploring 6 common mistakes that investors often make and how to avoid them. And who better to guide us through this than the investment gurus themselves? Warren Buffett and Charlie Munger. Warren Buffett, known as the Oracle of Omaha, is one of the most successful investors of all time. His partner, Charlie Munger, is equally respected in the field. Their success in investing is not just about their returns, but also about their wisdom and approach to investing. Warren Buffett and Charlie Munger have a unique investment philosophy that has helped them consistently outperform the market. Their approach is rooted in value investing, which involves buying stocks for less than their intrinsic value. This strategy requires patience, discipline, and a deep understanding of the company and its financials. Their partnership at Berkshire Hathaway has become legendary in the investment world. Together, they've built a diversified portfolio of high-performing companies, delivering impressive returns for their shareholders. What's remarkable about Buffett and Munger isn't just their success, but how they've managed to avoid the pitfalls that ensnare many investors. They don't chase trends, they don't panic when the market dips, and they don't let emotions cloud their judgment. Instead, they stick to their principles, invest in what they understand, and always keep a long-term perspective. Mistake number 1, trying to time the market. Market timing is an investment strategy that tries to predict future market price movements, with investors buying or selling based on these predictions. The allure of this concept lies in its seeming promise of maximizing returns and minimizing losses. However, accurately forecasting market movements is an extremely challenging feat, even for the most experienced investors. The unpredictability of the market, influenced by a myriad of factors such as economic indicators, geopolitical events, and investor sentiment, makes market timing more akin to gambling than strategic investing. Renowned investors Warren Buffett and Charlie Munger have consistently advocated against trying to time the market. In his 1991 letter to Berkshire Hathaway shareholders, Buffett wrote, "We continue to make more money when snoring than when active." This statement highlights their belief in the power of passive investing. Buying shares in high-quality companies and holding on to them over the long haul rather than trying to profit from short-term market fluctuations. Charlie Munger reinforces this philosophy. Speaking at the 2019 Daily Journal annual meeting, he said, "The idea of thinking you can make money by watching for little signs and buying and selling securities, it's a demented activity." The message they both convey is clear. Focus on the intrinsic value of companies, buy at reasonable prices, and hold for the long term. Mistake number 2, chasing hot stocks. Chasing hot or trending stocks is another common pitfall for investors. Often fueled by FOMO, fear of missing out, investors are drawn to these popular investments, hoping to ride the wave of their success. However, this approach often leads to buying high and selling low, a recipe for investment disaster. Without a thorough understanding of the company's fundamentals or why its stock is surging, investors are merely speculating, not investing. Buffett and Munger strongly advise against this behavior. They emphasize the importance of conducting your own research and understanding a company before investing in it. Buffett has famously said, "Never invest in a business you cannot understand." They advocate for investing in companies with solid fundamentals, good management, and a sustainable, competitive advantage, qualities that ensure the company's longevity and profitability. Following this advice means you're investing based on knowledge and sound reasoning, not just because a stock is making headlines. Mistake number 3, ignoring value investing. Value investing is a strategy that involves purchasing stocks that appear underpriced compared to their intrinsic value. The intrinsic value of a stock is a measure of what an asset is worth, taking into account tangible and intangible factors, rather than its current market price or short-term market trends. This strategy requires patience, thorough research, and a long-term perspective. This method is the bedrock of Warren Buffett and Charlie Munger's investment philosophy. They seek out companies whose shares appear undervalued but have strong fundamentals and potential for long-term growth. Some of their most notable investments, including Coca-Cola and American Express, were made at a time when these companies were not fully valued by the market, thus providing an opportunity for substantial returns as the market corrected over time. In his 1989 letter to shareholders, Buffett encapsulated the essence of value investing with his statement, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This reflects their belief in investing in high-quality companies at reasonable prices rather than mediocre companies at bargain prices. Mistake number 4, lack of diversification. Diversification is a key principle in investing that involves spreading investments across various assets, sectors, and geographical regions to mitigate risk. The idea is that if one investment underperforms, others might outperform, thus balancing the total portfolio performance. Warren Buffett and Charlie Munger, while known for their concentrated investment approach, appreciate the importance of diversification. Their conglomerate, Berkshire Hathaway, has a broad portfolio encompassing a variety of businesses across different sectors. However, they also warn against over-diversification or diversification, which can dilute potential returns. As Buffett famously quipped, wide diversification is only required when investors do not understand what they're doing. This suggests that while diversification can protect against ignorance, a well-informed investor can achieve higher returns with a more focused portfolio. Mistake number 5, short-term thinking. Short-term thinking in investing is a common pitfall where investors focus on immediate gains or losses, often culminating in impulsive and potentially detrimental decisions. These might include hastily jumping into trending stocks without sufficient research or panic selling during a market downturn. Both actions can lead to significant financial loss. Veteran investors Warren Buffett and Charlie Munger are vocal advocates for the long-term approach to investing. They emphasize the importance of buying and holding high-quality investments, allowing them to grow and compound over time. This strategy requires patience and discipline, but often results in substantial returns in the long run. Buffett's well-known advice, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, underscores this philosophy and serves as a reminder to investors to resist being swayed by short-term market fluctuations. Mistake number 6, letting emotions drive investment decisions. Emotions can be a significant obstacle on the path of successful investing. Fear during market downturns and greed during market booms can cloud judgment and lead to irrational investment decisions. These emotionally driven actions can significantly undermine potential returns and financial stability. Throughout their illustrious investing careers, Buffett and Munger have demonstrated remarkable emotional discipline. They encourage investors to remain rational and not let market sentiments dictate their investment decisions. Their famous mantra, "Be fearful when others are greedy and greedy when others are fearful," encapsulates this philosophy. It suggests that investors should resist the urge to follow the herd and instead capitalize on market overreactions to secure quality stocks at discounted prices. By doing so, they can make informed, rational decisions that align with their long-term investment goals and risk tolerance. Investing is a journey, not a sprint. It requires patience, discipline, and a clear understanding of one's financial goals. The wisdom shared by Warren Buffett and Charlie Munger, two of the most successful investors of our time, provides invaluable guidance for this journey. Their approach underscores the importance of long-term thinking, emotional discipline, and thorough research in making investment decisions. Their philosophy teaches us that investing isn't about chasing short-term gains or getting swayed by market trends. Instead, it's about understanding the intrinsic value of businesses, recognizing their long-term growth potential, and having the patience to let investments compound over time. It's about maintaining a balanced portfolio, but without falling into the trap of over-diversification. Above all, it's about keeping emotions in check, staying rational during market highs and lows, and not letting fear or greed cloud judgment. Applying these lessons in our own investing journey can make a significant difference in our financial outcomes. It can help us avoid common pitfalls, make informed decisions, and stay focused on our long-term financial goals. We hope this information serves as a useful guide in your investing journey. Remember, every investor's path is unique, and there's always more to learn. Stay curious, keep learning, and strive to make informed decisions. If you found this content helpful, please like, share, and subscribe for more insightful discussions on investing and personal finance. Your support helps us in our mission to provide valuable financial education to all.